Assalamu alaikum friends, welcome to today's standard. Today's standard is IFRS 11 joint arrangements. Now this is a very important standard, okay, because this comes joint arrangements. I can say, if I have to say in terms of percentage, this question comes 50 to 60% of the time joint arrangement comes. Okay, joint arrangements needs to be joint arrangements can be of two types. Either it could be joint operations and joint venture, and both are dealt using separate standards, okay, that we need to deal. So what are joint arrangements? In IFRS 11, you have to know the definitions. Definitions are very important. Definitions are automatically important on all the other standards, but some standards definitions are it's more important. For IFRS 11 is one of it, where definitions are very important. So joint arrangements are defined as arrangements where two or more parties have joint control. I will highlight this definition. So make sure that you memorize this definition and you learn it. Is an arrangement where two or more parties have joint control. The key word is joint control. If in your answer you are just writing control, you will not get marks. You have to write joint control. That means jointly they should have the control. It should be more than two or more. Two or more. Two is the minimum. One person cannot have joint arrangement. Okay. It should be two. It could be 2, 3, 4. There is no maximum number, but minimum is 2. And whoever it is, if there are 2, both should have control. That means joint control. If there are 3, all the 3 should have joint control. Is like that. That is the meaning of joint arrangements. Okay. This will only apply if the relevant activities acquire unanimous consent of those who collectively control the arrangement. That means whatever the activities they are doing, it requires unanimous consent of those who collectively control the arrangement. You need the consent of everyone. Okay. This word also has to be there in your answer. Who collectively control the arrangement. Everyone together, it's like a teamwork. It's like a group. No one person controls. Everyone controls equally. Joint arrangements may take form of either. It could be joint operation. It could be joint venture. First, we are going to go through joint operation. What is it in detail? Then we are going to go through joint venture. Okay. What is the difference? What is the difference between these two? The difference comes from based on the parties' rights and obligations under the joint arrangement. What are the parties' rights and obligation? Now let us go to the joint operations, and we'll have some examples of joint operation also. This is very important from your exams perspective also, because sometimes they might give you a scenario and you might get confused. What is it? Is it a joint operation or a joint venture? Because if you for joint venture, let's say it's a joint venture. The right answer is joint venture, but incorrectly you wrote joint operation, and you are using different standard for joint operation, then your whole answer will go wrong. That's why it's very important that you identify correctly whether it's a joint operation or a joint venture. Both are joint arrangements only. Both are under joint arrangements. But there are differences between joint operation and joint venture. They're not same. Okay? But both are defined as joint arrangements. Okay? So joint operations are defined as joint arrangements whereby the parties that have joint control have rights to the assets and obligations for the liabilities. If anything in your answer, if you see, if you're going through your textbook also, if you say something is bold, that means that word is very significant, that it has to be there in your answer. That's why it's in bold. Okay. I have highlighted it out for you also. So the parties that have joint control have rights to the assets and obligations for the liability. What is it? You have right to the asset also, you have obligation to the liability also. Normally there will not be a separate entity established to conduct joint operations. Not a separate entity to conduct joint operations. To conduct that joint operations, you don't have a separate entity. Okay. Now what is the examples of joint operation? Let us go through the examples. So A and B decide to enter into a joint operation to produce a new product. A undertakes one manufacturing process and B undertakes the other. A and B have agreed that decisions regarding the joint operations will be made unanimously and that each will bear their own expense and take an agreed share of the sales revenue for the product. Okay. So that is an example of joint operation. They are not a separate entity. They have the rights to assets and obligations for the liabilities. Clearly it's understood from this example. Now let us go to the accounting treatment. If you are going by the accounting treatment, if it's a joint operation, Which standard you have to apply? If the joint operation meets the definition of a business, okay, if the joint operation meets the definition of a business, then the principles in IFRS 3 apply when an interest in a joint operation is acquired. Not all the time. Not all the time joint operations are used in IFRS 3. Only if it meets the definition of a business. Right? Because look at the name of the standard of IFRS 3. It is business combination. So if anything is defined as business, it will be dealt using IFRS 3. Hence, joint operation is dealt under IFRS 3 if it meets the definition of a business. Now let us see what are the steps required. Okay. This is the bullet points, you have to know it. You have to know it, there is no doubt. Because these are your adjustments. This is the thing you need to write in your answer. How are you going to show your accusation? How are you going to show your assets or liabilities or cost or fair value of net assets acquired? All these things. So IFRS 3. All the rules of IFRS 3. Think about it. It will be applied here. Same like how you did for subsidiary. Normally you do for subsidiary. What do? Use IFRS 3. You calculate goodwill. So let's see here. So acquisition cost or expense to profit and loss as incurred. Same like for subsidiary also. Acquisition cost. Your purchase consideration. How much you have purchased that joint operation for. Let's say 2 million. So that 2 million is your cost. It's expense to profit and loss. Same way, dicto same way like how you do for subsidiary. There is no difference. If you have understood so well how subsidiaries and all, we calculate goodwill, we calculate fair value of FNC, all those things, you will understand this also. Same thing. Only the word is changed. There subsidiary, here is joint operation. Next, identifiable assets and liabilities of joint operation are measured at fair value. Okay. Even in there also. Subsidiary also. Assets and liabilities we measure at fair value. There it's subsidiary. Here the word is joint operation. I've told you only the word changed. Steps, all the 3 steps are similar to how normally we calculate. Excess of the consideration transferred over the fair value of the net assets acquired is recognized as goodwill. Here also you recognize goodwill. There also you recognize goodwill. That means your consideration minus your fair value of net assets, okay, is recognized as goodwill. Normal way. One thing is missing here. If you have noticed in the last point, what is it? I want you to figure it out. Let me see how many of you can figure this out. If you are so good in if you have done the questions in revision kit, the group accounting questions, you must be familiar with this by now. Yes, it is the NCI, non-controlling interest, that is missing here. Why? This is a joint operation, my dear. This is not a subsidiary where you will have a non-controlling interest. So that fair value of non-controlling interest is only missing. Rest everything remains same. Okay? That will not come in joint operation. Rest everything is same. So this is the beauty of group accounting. You remember one thing. If you know one standard properly, it will help in the other standards also. When you have to apply the same thing. That means that shows you should have a very deep understanding and you should have some knowledge of IFRS 3. If you are so well in IFRS 3, you will be good in other standards also. Like for example, this one, IFRS 11. Let us go to this one. At reporting date, individual financial statements of each joint operator will recognize. This you should know. Not only in the, what is this? IFRS 3. Okay, you also should know in the individual financial statements for each joint operator how you have to recognize. Let's say A and B. There are 2. So in A, they have to record their share. In B, they have to record their share. Okay. Share of what? Share of assets, liabilities. Okay. Share of assets held jointly, share of liabilities incurred jointly, share of revenue from joint operation, share of expenses from joint operation. Isn't it very easy? You read it and it's there. It's already memorized. You don't have to, you know, it's just their share. That's it. If it's 50-50, then 50% of assets goes to A, 50% of assets go to B. Same for liabilities, revenues, and expenses. That is joint operation. So joint operation is pretty much easy actually. Joint operation operators share of the income, expenses, assets, liabilities. Remember these four words. Okay, it's just the joint operator share of these four things. Of the joint operation are included in his individual financial statements, and so they will automatically flow through to the consolidated financial statements. What does it mean? If it's there in the individual financial statements, automatically it will be consolidated. Why? Which standard are we using? IFRS 3, don't forget. IFRS 3 means we have to consolidate. It is used for consolidation only. Normally, how we do for subsidiary. So, when you're writing individually, automatically, using IFRS 3, you will consolidate. Okay? That is for joint operation. Now, let us go to joint venture. When you're studying IFRS 11, first study joint operation very well until you are so perfect in joint operation. Next, then you go to joint venture. Don't study two things at the same time. You will get confused. Okay? So now let us go to the joint venture. Joint ventures are defined as joint arrangements. You see, this is also joint arrangements. But the difference is here. There the party had the right to the assets and the liabilities. Here, the parties have the joint control of the arrangement and have rights to the net asset of the arrangement. This is net asset. Can we go back and check the definition of the joint operation? It's important that now you see the difference. Here it is regarding to the assets and the liabilities. Okay? Rights to the assets, obligation to the liabilities. But here they're talking about net assets. They have the rights to the net asset of the arrangement. They didn't talk about the obligation of the liability. No assets, net asset. So the word is net asset. The moment you see net asset, it is joint venture. If they have mentioned about liabilities and assets, it is joint operation. But we'll definitely have an example for that also, okay? Here, another difference is, joint operation, we told that there are no separate entity, but in joint venture, there is a separate entity. They will normally be established in the form of a separate entity. This is second difference to conduct joint venture activities. Example, A and B decide to set up a separate entity C. So when you see this kind of statement, automatically it's a joint venture. To enter into joint venture, A will own 55% of share capital of C, B owning the remaining 45%. A and B have agreed decision making regarding joint venture will be unanimous. It will be unanimous whether it's joint venture or joint operations, okay? Neither party will have direct right to the assets. You see, no one will have the right to the asset. So it cannot be joint operation. Joint operation, you should have the right or direct obligation. So it's not an operation. It's a joint venture. Instead, they will have an interest in the net asset of entity C to set up the joint venture. In which entity? Not A, not B, in C, the separate entity. They will have the interest in the net asset. So this kind of sentences or words you see in your case study, understand that it's a joint venture. Okay. Accounting treatment. Accounting treatment is the most in every standard. This is what you need to know. You need to know in the consolidated also as well as in the individual financial statements, because this question is almost asked. Not only for this standard, but almost all the other standards also. Impact in individual financial statements versus impact in the consolidated financial statements. So in the individual financial statements, an investment in a joint venture can be accounted for. Same. Okay. It is same. Joint venture. At cost in accordance with IFRS 9 or using equity method. Using these three methods. Okay. But this is in the individual separate financial statements. Okay. So when you go through I have completed standard before this. It is IS 27, I guess. Yes. It is IS 27, which is separate financial statements. There's a separate standard on separate financial statements. There, same thing I have discussed. That whether it's an investment in subsidiary, associate, or a joint venture, it is accounted using these three methods. So if you have seen my IS 27 video, you definitely will understand this much faster. This is the same thing which is repeated here. At cost according to IFRS 9 using equity method. Next. That is in the separate. What about the consolidated? Which standard are we going to use? So in the consolidated financial statements, the interest in the joint venture entity will be accounted using equity method. Equity method in accordance with IS 28. IS 28 is not only IS 28 not only deals with associate but also joint venture, not operation, joint venture. So you see joint operation, you use IFRS 3, but when it's joint venture, IS 28. You understanding? In the consolidated financial statements. So joint venture also equity method, associate also equity method. Both are dealt under IS 28. So if you see the treatment of joint venture in the consolidated financial statements is therefore identical to the treatment of an associate. If you know the treatment of associate, you will automatically understand the treatment of joint venture. Okay. So we have a testy understanding. We already have this one testy understanding. But definitely before this, let us go through the illustration. Okay. Blast has 30% share in a joint operation. So they will tell you joint operation. Okay. So it's a joint operation. Assets, liabilities, revenues, cost of joint operation are apportioned on the basis of shareholding. Following information relates to joint arrangement activity for the year ended. So we have 1, 2, okay, 2. Manufacturing facility cost 30 million to construct and was completed on 1st December 2001 and it was to be dismantled at the end of its estimated useful life of 10 years. Present value of this dismantling cost to joint arrangement was using discount rate 8% was 3 million. During the year end, joint operation entered into the following transactions. What is it? Goods with a production cost of 36 and sold for 50. Operating cost 1 million. Administrative cost 2 million. Blast has also accounted for a share of the cost of manufacturing amounting to 9 million. Revenue and cost are receivable and payable by 2 other joint operation partners who will settle amounts outstanding with Blast after each reporting date. Now what are you required to do? Show how Blast will account for the joint operation within its financial statements. This is a joint operation. Clearly they have told. So there is no doubt. You have to use which standard? Which standard? IFRS 3. If it's consolidated. So if you see the answer, this is the answer. Okay. Financial statements. Okay, so financial statements means what? You have to do the profit and loss account as well as the statement of financial position. Start with profit and loss. Okay, but before this, let me take a picture of this. Right? Let me. So now let us go to the answer. Okay, I have taken the picture of the question. Now starting with profit and loss. So you start with the revenue. How much is the revenue? They have told that revenue is 50 million, right? It has been sold with 50 and production cost was 36 million. So joint operation. Okay, what is the percentage? They have given 30% because Blast has 30% share only. So everything will be taken in 30%, whether it is cost, whether it's revenue, whether it's your asset, whether it's your liability. So you start your revenue with 50 million into 30%. Cost of sale is given 36 million, that is also into 30%. Operating cost is also given, which is 1 million into 30%. Admin expenses also you have been given 2 million into 30%. Depreciation we have to find out. Finance cost is also there. Okay, finance cost means that discount rate which is given to you in bullet point 1, 8%. Okay, 8% into 3 million. That dismantling cost and all, you have been given the discount rate which is 8%. So for that you have to, that's the finance cost, 3 million to 8% into 30%. What we need to find is the depreciation. How do you find the depreciation? I'm going a little bit fast. I'm assuming you have the question in front of you. Okay. So they have told that the manufacturing facility cost is 30 million. That 30 million is non-current asset. Okay. 30 million to construct. So that 30 plus the 3 million, the dismantling cost you have to add. So that 30 plus 3 divide by 10 because they told useful life is for 10 years and into 30%. Depreciation also you have to take 30%. It's a cost, it's an expense. So you finally deduct everything and whatever you get, this 2.238. It is what? Share of the net profit rejoin operation, including retained earnings. So this, where will you put it? You will include within the retained earnings in the statement of financial position. Now let us go to the statement of financial position. So you start with property, plant and equipment. Okay. So property, plant and equipment. How much is your property, plant and equipment? It is 9 million. 9 million because they have told that Blast has only accounted for its share of the cost of manufacturing facility, which is 9 million. So out of that 30 million, 9 is for Blast. So you are taking 9 million. Now depreciation is only 3 on 3 million, 30%. Even dismantling cost, okay, that you need to add with this property, plant and equipment in the statement of financial position. You might be thinking that this is a cost, why is it coming here? Because this needs to be added here with that 9 million. Because this 9 million is only given on your manufacturing facility. But here when we have taken the depreciation, remember we have added 30 plus 3. So that this 9 is out of this 30. What about this 3 million? We have taken that as non-current asset. So that dismantling cost also we have to take 30% of it in the non-current asset. Property, plant and equipment we have to add. So 3 million into 30%. Then depreciation we have to take out of 33. We are saying we are taking this 3 million plus this 30. Therefore 33 million. 1 divided by 10 because useful life is 10 years into 30%, minusing it and the carrying amount. Then we have receivable. Okay, what is the trade receivable? Did they give the share already? $15. And dismantling provision, remember, it comes under non-current liabilities. Okay, it's for long term, not in the current year. So dismantling, it will come as a dismantling provision. So that 3 million into 30%, you have to add this 0.072. What is the 0.072 which you are adding with it? It is your finance cost. Okay, this finance cost you need to add because you are taking on that 3 million, you are taking 8% into 30% as the finance cost. That needs to be added with non-current liability. Okay, because on that 3 million only you are taking interest. So you take it. Then current liabilities comes. Okay, which is 10.8 plus 0.3 plus 0.6. Okay, what is this figure? How did you get this 10.8, 0.3 and 0.6? Share of expenses to pay. That comes in trade payables, right? So let us go and check our expenses. So what is the expenses? Which is 10.8. Okay, operating cost 0.3. Then we have admin expenses 0.6. So we are adding all these three here. That's it. Which is 11.7. Because trade payables they have told which is a share of expenses to pay. That is your trade payables. Because they have clearly mentioned that revenue and cost are receivable and payable. Okay, the revenue is receivable, cost are payable. But remember, in the trade payables, we are not taking this finance cost and this depreciation. Why? Because this depreciation impact we have already taken here. Okay, and this finance cost impact we have already taken under non-current liabilities here. So we are not taking in the current liabilities. We are only adding the other three. The cost of sales, your admin cost plus your operating cost. Now we have, so the receivable 15 million, this is your share revenue 15 million. Okay, this 15 million. And finally, so let's see. That's it. So the amount calculated above should be classified under the appropriate headings within the statement of profit for the year's statement of financial position. Note also that where there are amounts owed to and owed from a joint operating partner, it may be acceptable to show just a net amount due to from each partner. So you can show as a net amount also. Okay, where you have to owe and you are getting it, you are owed by someone, and you are also owing someone and you are owed by someone. You can net it off and show it. Okay, they are acceptable. That is acceptable to do. Then, so we are over with the IFRS 11 joint arrangements, but even those joint arrangements, so many other standards also we did, IFRS 3 and IS 28. So this illustration is over, and I will like to end this standard with testing understanding, because there's only one testing understanding related to this IFRS 11. So let us finish this too. A, B, and C establish a new entity which is called D. A has 50% of the voting rights in new entity, B has 30, C has 20. Contractual arrangements between A, B, and C specify that at least 75% of the voting rights are required to make decisions about the activities of entity D. Discuss how A should account for its investment in D in its consolidated financial statements. Okay. So the question is only about A, and the question is asked on the consolidated. Do not get confused with the separate financial statements and consolidated financial statements. The treatment is different. Okay. So A, how much A has? A has 50%, while the other has less than that, 30 and 20. And they should at least have 75% of the voting rights required, A, B, and C. So now you need to show, you first need to define whether they have joint control also or not. So let us see test understanding. This is test understanding 13. So we need to go to test understanding 13 to see that. Okay. So this is test understanding 13. Okay. A does not control the arrangement because it needs the agreement of B when making decisions. Is it true? C, they told that at least 75% is required, but A only has 50% and B has 30%. So even if they take C also, they will not get the control because C has 20%. So 50 plus 20 is just 70. You need more than 75. So A and B will make more than 75%. 50 plus 30, which will make 80%. So unless A is in joint control with B, A and B has the joint control, they cannot lead D. So that what does it mean? A does not control the arrangement. A cannot control because it needs the arrangement of B when making decisions. This would imply A and B have joint control of the arrangement, because decisions about the activities of the entity cannot be made without both A and B agreeing. Both should make decisions together to pass that 75% threshold. In the consolidated financial statements of A group, D should be treated as joint venture, not joint operation. Why? This is because it is a separate entity over which A has joint control. You see, it's a separate entity. D is a separate entity where A has joint control. Joint means A plus B. So the joint venture will be accounted using which method? Equity method. So whenever you say something, even in the exam also, when you say that this is classified as joint venture, you need to first write why it is a joint venture. For example, you can write that they have separate entity and all. Then you need to use how it is accounted using equity method. Okay, which is IS 28. So that's it for IFRS 11, and see you in the next video. Till then, take care.